So you leave Australia, and the Australian tax office goes, "Congrats! You just sold your portfolio." You didn't. But Australia pretends you did anyway. That's the deemed exit tax, a tax bill for an imaginary sale, a bit like being fined for a party you thought about having. The good news, you get a choice. The tricky news, the choice can change who taxes you later. Australia, the UK, both. Or rarely but beautifully, neither. When you stop being an Australian tax resident, the ATO treats most non-property investments as sold at market value. Shares, funds, crypto, foreign investments. And Aussie property? This is usually excluded because it's taxable Australian property, which has its own special brand of chaos later. But for the rest, you can either pay now and ATO taxes the pretend sale, or defer by electing to disregard it, and Australia waits and keeps those assets in its net. But be aware, there is no cherry picking. It's all in, like ordering Surprise Me at a restaurant run by accountants. All right, here's where this stops being theory and starts being which button do I press without causing a small tax incident. There are basically three paths, and the outcome depends on two things: whether you pay Australia on the way out, and where you're living when you eventually sell. None of which require panic, but all of which reward getting the order right. Option 1, pay now, sell later in the UK. If you pay the Australian exit tax when you leave, Australia basically says, all good, we're done with you on those investments. So when you eventually sell them while you're living in the UK, Australia won't charge CGT again, but the UK might, because HMRC taxes the actual sale. And here's the mildly irritating part. The Australian tax you paid is often not creditable in the UK, since Australia taxed a deemed sale. And the UK is taxing the real one? Same investment but a different tax moment. And the treaty doesn't always play nice. Now the upside. If you qualify for the UK's FIG regime, the UK could charge zero tax on those foreign gains. And that can make pay Australia once the clean, simple outcome. Okay, option 2 is deferring the exit tax. That means you don't pay Australia when you leave, but Australia may still want CGT later when you actually sell because you chose to defer. Meanwhile, the UK may also tax the sale. Usually that's manageable because if both countries tax it, you can often use tax credits to stop it turning into a double hit. But here's the one gotcha to be aware of. If you sell while claiming the UK's FIG regime and your UK tax comes out as zero, there may be nothing to credit against any Australian CGT. So Australia could still take its slice, and the UK won't be charging anything to offset it. Now for the fun part, the treaty. There's a clause we call the Golden Clause, Article 13.5. If you deferred and you're treaty resident in the UK when you sell, it can mean the gain is taxed only in the UK, and Australia steps back. This is mainly for portfolio investments like shares. And when that lines up with FIG, you get the unicorn result. Australia doesn't tax, the UK doesn't tax, and the CGT bill can be zero. Not automatic, but very real when the facts line up. Which brings us to option 3, pay now, move back later. If you pay the exit tax when you leave, then you don't sell anything while you're away, and later you move back to Australia, the ATO basically draws a line in the sand, and your cost base can reset to the market value when you left. So, Australia generally only taxes any gains that build up after you become an Australian resident again. It's surprisingly sensible, which in tax is always a little suspicious. Now, before I go, remember that special brand of chaos as I mentioned at the start with property? This is it. Shares can be all about timing and treaties, but Australian property plays by its own rulebook. Australian property usually isn't hit by the exit tax, which sounds great until you sell. If you sell your former home after you've become a foreign resident, you can generally lose the main residence exemption under the rules that changed after 13 June 2020, unless you fit a pretty narrow life events exception. And there's a cash flow twist. From 1st of January 2025, foreign residents selling Australian property have 15% withheld at settlement. It's not always extra tax, but it can feel like your sale proceeds just took a surprise detour. As always with Australian property tax, speak to an Australian tax advisor before you make any moves. Here's what to do without spiraling. This really comes down to 4 things: what you hold, shares or property, when you plan to sell, whether you qualify for the UK's FIG regime, and whether Article 13.5 applies to you under the treaty. Get those right and it's optimization. Get them wrong and it's, why are 2 tax officers emailing me like they're in a group chat? So the exit tax decision isn't about bravery. It's about picking the route that makes the treaty and FIG work with you, not against you.